Costco Wholesale Corporation, ticker symbol COST, is down ever so slightly here in the after hours after reporting its most recent quarterly earnings. And we're going to talk about it. It was a very volatile after hours session, the stock ripping up and then falling back down to even below the close price of the day. So let's talk about Costco. What does it mean for the stock, the consumer? Are they growing? And is Costco a buy right now? But guys, before we dive in, if you could please go ahead, like and subscribe. Really helps a small channel like mine out. Let's dive in with first, what does Costco do? And I'm sure you all know this, but Costco, together with its subsidiaries, engages in the operation of membership warehouses in the United States. So it just has these massive warehouses and it offers branded and private label products and sort of sells them in bulk all across the world. Now, this is Costco's business model. It operates at scale by buying in bulk. It can then pass on those cost savings to the customer. So by increasing its scale, it lowers its prices. So essentially, the bigger Costco gets, the more merchandise stores it owns and operates, the wider the moat becomes. And you can see here that lower prices mean a better value proposition for the customer, which means increased scale and efficiency because they get more customers. And this results in lower costs per dollar of revenue and then cost savings returned to the customer, which means you're going to get, increased customers, increased scale. Increase customers, increase scale, and that's going to obviously deliver outsized value to shareholders. So, the bigger Costco scales, the wider the moat becomes. Knowing that, let's talk about the earnings now. Revenue grew 8.1% on a year-over-year basis for this quarter. That actually beat the analyst expectations ever so slightly by about $100 million. So it wasn't a magnificent beat. EPS grew 13.2%. And again, a very slight beat right here. But look, double-digit EPS growth, that's pretty solid in aggregate. The metrics around the clock were really good. Gross margins expanded, net income margins expanded, free cash flow margins also expanded. But this is a very thin margin business. And, most shopping retailers tend to have very thin margins. Look at Walmart, for example. So, you're looking at low single-digit net income margins, free cash flow margins right here. But because of the scale of the business, you tend to see net income of about $1.9 billion in the most recent quarter. And this is up from the previous quarter of $1.6 billion. And then free cash flow of about $2.3 billion. And again, this was up from $1.9 billion in the same quarter last year. The company has $14 billion cash at hand, $8.1 billion debt. So the balance sheet looking very good. And in aggregate, this was actually a very solid quarter. To me, it was just a business as usual for Costco. The company doing what it does every single quarter, and that's, growing that top line, keeping the expenses intact, and that resulted in net income growing 13.2%. You could see that operating expenses grew 7.7%, revenue grew 8.1%, and that's how you get net income growing in the double digits. So great operating leverage. The company reports revenue in really two segments. It sort of has the total company revenue, and then it splits it into the e-commerce here. Now we're going to look at the adjusted figures, which excludes impacts from changes in gasoline prices and foreign exchange. And you can see here that the e-commerce segment grew 15.8%. The total company grew 8%. And even if you don't look at the adjusted figures, you're still looking at about 15% growth for the e-commerce segment. So this is really driving the majority of growth and operating leverage. And I think that's probably why the stock trades at the premium it does, along with the actual business model itself. This e-commerce segment is still growing at a pretty robust pace, especially considering the scale of Costco. It's actually really impressive to see this type of growth metric right here. The company's doing $400 billion a year in revenue. So to see this type of growth, kind of impressive in my opinion. Now, looking at comp sales and adjusted comparable sales, we'll just look at the adjusted figures right here to sort of get a more nuanced look. Now, comparable sales in the US was up 7.9%. And you can see this was both of an increase in overall prices as well as traffic. So foot traffic actually increased. So this is the volume increase that contributed to this more than it was actually the raising of prices. That was actually true across the board here with Canada and international as well. So foot traffic in terms of, more people coming to Costco stores versus price increases. And that resulted in 7.8 and 8.5% growth for total company growth of 8% in aggregate. So very solid stuff to actually see volume increasing. That's actually what you want to see in a business because, this business at Costco at least doesn't increase pricing. It sort of passes on the savings to the consumer. So, a lot of the growth is driven here by that volume. And that's exactly what Costco is doing. They're opening more stores. They're getting more people into their stores. And that's why the company is growing, at the pace it is here, about 8%. And then, earnings by 13%. Now, the business, you need to be a Costco member to enter the store. And this is some great data we have here directly from their presentation. Now, membership income grew 10.4%. Membership income excluding foreign effects changes actually grew 11%. Now, paid memberships was 79 million, and that grew 6.8%. So you are seeing volume growth. It's not just price increases, and Costco do increase their prices for their memberships. But yeah, look, 6.8% growth in actual volume of people coming to Costco. And this is like super high margin, their memberships. Many people say that Costco's business model is to break even on the actual merchandising and then to profit off the memberships in aggregate. And then total cardholders grew 6.6%. There's 142 million. So it's a massive, massive company with tons and tons of data to execute an immense scale with this type of customer right here. Now you can see here that executive memberships was 37 million. Penetration of sales and executive members was 73%. And the worldwide membership renewal rate was 90%. The US-Canada renewal rate was 92%. So incredibly high retention rate, especially for a consumer business, very low churn. That's really, really good. And look, ultimately, if you're investing in Costco, these are the data points you want to look at. You want to see how much they can increase prices. Is the value proposition worth it? And can they increase volume? And if they can do that, Costco will do very, very well in the future, particularly as it pertains to revenue growth and earnings per share growth. Now, the company doesn't provide, specific guidance figures, but what they do give you is sort of like their warehouse estimates. Now, for this quarter right here, the third quarter 2025, 8 warehouses were opened up. In the previous quarter, it was 1. And they have 890 total warehouses across the board. Now, this was because we saw 7 warehouses opened in the US, 1 international, 0 in Canada. And so the majority of the growth coming from this US segment in aggregate. Now, for the rest of the financial year, the US is looking at opening 5 more warehouses, 1 in Canada and 3 international. So 9 more for, Costco in general. And they should end the year with 914 total warehouses. So look, going from 890 to 914, you're clearly seeing demand there. And that's obviously how Costco grow revenue in aggregate. And then obviously comp sales is, stores open for a year or so. But so the company will keep growing, and you are looking for, I would say probably for the rest of the year, at least on a quarter-over-quarter basis, you probably look for 8 to 10% more growth in the business overall. But where does it leave us with valuation for Costco? And we all know that Costco trades at some crazy valuation, partly because the bigger the company gets, the wider its moat, the wider scale it has. And also, memberships being super high margin means that the business trades at a ridiculous valuation here. You're looking at, 50 times price to earnings, 32 times EV to EBITDA on what is a very, very low margin business, and, a shareholder yield less than 1%. Now, if we break down, how we look at valuation, if we plug in the revenue growth and assume 5% through 2029, I wouldn't be surprised if that is actually a little bit higher. I would say 7% would be more accurate, but we're going to use 5% and then 3.7% free cash flow margins. I think you could probably use a 4% level, to be honest. We're being very conservative here with Costco, which I think you should be, especially given the valuation. So you're looking at $12 billion in free cash flow, at the end of 2029. If we then use a 35 multiple, and the current multiple is 63 times, this is the EV to free cash flow. So if we use a 35 multiple, which is double the S&P 500 market multiple, you then get the enterprise value, subtract the net debt, then you get to divide by shares outstanding. And we are looking at shares outstanding decreasing ever so slightly by about 1% every single year, which again, I don't think that's going to be the case, but for valuation purposes, we are. Then you get, $1,156 share price in 2029. The current share price is about $1,000. So for the next 5 years, you're looking at about a 3% return compounded. And I mean, that's with a 35 EV to free cash flow. That's, like Nvidia trades at 33. So, there's that. Nvidia is growing faster, has a higher nominal revenue figure, has higher margins, and is actually buying back more shares. So, there's that situation. So, in aggregate, is Costco expensive? Very, very expensive. And I think, these figures, even if we're being conservative here, is probably very, very frothy. And I would peg fair value at a 12% discount rate at $655. So, the business would have to fall maybe 40% from here to approach our fair value. And I think even at that pace right there, you're probably looking at about 12% returns, 13% returns, compounded over the next 5 years. And in that case, I think the S&P 500 would still be a better buy. On a technical level, you can't fault the fact that Costco has done one thing in the last year, and that's just moved up and to the right. It does look like whenever we get to this moving average right here, Costco is good for a trade. If we do pull back to this level, I would say probably, you enter a trade there with tight stops and look for upside, maybe to retake those all-time highs. I think this earnings report is good enough for Costco probably to go ahead, reach those all-time highs, sometime in the next 3 or so months, assuming the macro holds up. Do we get a pullback? I don't know. Maybe with tariff concerns, then there might be an issue. There might be a situation. We didn't hear much tariffs with regards to Costco. But those negotiations are definitely happening in aggregate. So if you do get a pullback here to this level, I would probably buy there, aim for all-time highs. Really longer term investors, this is definitely a name you want to stay out of. That being said, had you bought it last year this time, you would have doubled your money when the S&P 500, has been largely flat in the last year. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.